Discord. We will prioritize those questions. You can also ask your question on YouTube. David and I will be checking in on YouTube, getting your questions queued up. This is really an opportunity for you guys to ask questions of Tascha and of the Alpha Finance Project. We do this on the YouTube, and then we also put it out on the podcast too. So if you prefer listening to it in podcast format, you can get it that way too. David, we should just introduce folks to Alpha Finance and Alpha Homora specifically. What do you want to say as an intro to this exciting, cool project?
Yeah, it's really exploded into the forefront recently, which it's always pretty cool when a project does that, when it just rises out of the very chaotic world of DeFi into the forefront of people's minds. The Alpha is famous for being able to provide really, really, really strong yields on Ether, above and beyond what you would get from ETH staking. And the way that Alpha does that is what they've called leveraged yield farming. So I have my questions as to what that entails, how risk is controlled, what the participants are in the system. Apparently, Alpha is originating more loans than AAVE, which is pretty insane because AAVE is like the canonical lending platform. So we're going to get into all these questions in just a little bit. But before we do, we're going to talk a little bit about these sponsors that make this show possible.
All right.
Gemini is the world's most trusted cryptocurrency exchange. I've been a customer of Gemini since I first got into crypto in 2017, and it's been my main exchange of choice to make my crypto buys and sells. Gemini is available in all 50 states and in over 50 countries worldwide, and on Gemini there are markets for over 30 various different crypto assets, including many of the hot DeFi tokens, and it's one of the few exchanges that has liquid DAI markets. Gemini just launched their Earn program, where you can earn up to 7.4% interest on 26 various crypto assets. If you're tired of paying fees in DeFi, or you don't want to worry about DeFi exploits, but you still want to earn interest on your crypto assets, Gemini Earn is the product for you. Another product I'm stoked to get my hands on is the Gemini Crypto Back Credit Card, which gives you 3% cash back on all of your purchases, but paid to you in your preferred crypto asset. When I get my Gemini credit card, I'm going to make sure that I get my cash back in ETH. So whenever I buy something, I get a little bit of ETH bonus back to me at the same time. You can open up a free account in under 3 minutes at gemini.com/gobankless. And if you trade more than $100 within the first 30 days after sign up, you'll be gifted a free $15 Bitcoin bonus. Check them out at gemini.com/gobankless. AAVE is a borrowing and lending protocol on Ethereum, and just recently released AAVE version 2, which has a ton of cool new features that makes using AAVE even more powerful. With AAVE, you can leverage the full power of DeFi, money Legos, yield, and composability all in one application. On AAVE, there are a ton of assets that you can deposit in order to gain yield, and all of those same assets can also be borrowed from the protocol if you have deposited collateral. Here you can see me getting a 200 USDC loan against my portfolio of a number of different DeFi tokens and ETH. I'll choose a variable interest rate because it's a lower rate than the stable interest rate option, but I could choose the stable interest rate option if I wanted to lock that interest rate in permanently. One of AAVE's V2 features is the ability to swap collateral without having to withdraw your assets, trade them on Uniswap, and then deposit them back into AAVE. AAVE does all of this for you, all in one seamless transaction, so you don't have to repay loans in order to change the collateral you have backing them. Check out the power of AAVE at aave.com. That's AAVE.com.
All right, guys, we are back with Tascha from Alpha Finance for this community Ask Me Anything. Tascha, how are you doing today?
Good, thanks for having me.
Tascha, I want to get into your background actually first and talk a little bit about where kind of you came from. So you've got investment banker in your Twitter bio. So maybe you might be the first banker guest we've had on Bankless, which is kind of fun. So tell us how you fell down the DeFi rabbit hole and found yourself building a DeFi protocol.
Yeah, so, since when I was studying at UC Berkeley, I've always been interested in crypto and blockchain space. And, Berkeley and the Bay Area are very, tech savvy and friendly space, right? So that's how I first got exposed. And then it just keep studying, learning more about the whole space. And generally, I like finance and I like tech, right? So, when I first started my career, I decided to join a tech investment banking role. So that means that I'm doing financial services for tech clients across the US and across the Europe as well. And then when DeFi started to become more, dominant and also becoming the main use case of blockchain, that's when I really got, very, very excited and trying to learn more about it. And pretty much, yeah, after finance role, I pivoted to more tech, to product management at Tencent, and then pivoted to more blockchain at Band Protocol, and then now DeFi, right? So it's been a journey, but it's been quite some time that I've been interested in studying the whole space.
That is super cool. So did you come into crypto by way of more DeFi, or did you come more by way of like the Bitcoin sort of path?
It's the Bitcoin path.
Okay, gotcha. So you started with Bitcoin and then went into kind of the DeFi side of things. Okay, well, so tell us about Alpha Finance, and why you decided to focus on the areas that you're focusing with this DeFi protocol.
Mm. Yeah, so you have to think Alpha Finance as a DeFi lab. And what that means is that we're incubating and innovating a number of DeFi products. The goal of each of the products will be different. So the problems we're solving will be particular to particular area for each product, right? But then at the end of the day, all of these products will work as an ecosystem. And then the whole ecosystem, we're focusing on the main goal instead of focusing on one particular area of DeFi that we want to innovate in. So the main goal that all of these products as an ecosystem will work towards is to maximize the returns for users and also minimize the downside risks. So, once we achieve this goal, then of course we would go for the bigger goal. And ultimately, at the end of the day, we are here to hopefully change and pretty much reform traditional finance. But given DeFi landscape now, given the regulatory landscape, it would be some time. So what we're doing now is pretty much trying to make very useful and staying at the forefront of DeFi and pretty much grow Alpha and DeFi to the point where we can make more and bigger impact later down the line.
So this is a theme that we've seen arise out of a number of projects that came out of DeFi Summer and just the most recent cohort of DeFi projects. Notably, YAM started off as this rebasing thing, but then it grew its treasury and now it produced the Umbrella protocol. And so it's kind of acting like a DAO that just produces products. We're also seeing the same thing out of SushiSwap, which first started with a clone of Uniswap, but now has Bento Box, which is something totally different, a borrowing lending platform. Would you say Alpha is similar to that, or is the product side of Alpha and like the DAO side of Alpha different? Well, how would you compare and contrast these different organizations that are living on chain?
Mm-hmm. I think there are multiple differences, right? Like the first one is I think it like how we progress and how the other progress may be different. The end goal may be the same, in which that there are multiple products as an ecosystem. But for Alpha, we created as the first day, knowing that it's going to be an ecosystem. So that means that we structure the team, the way that we work, the way we build are a bit different. We're always going to be on the lookout of new opportunities, trying to see which market is looking for which product. Perhaps, let's say, if we come up with a new product tomorrow that we think that it really fits with the market landscape right now, we might just ship it before the products that we have announced. So I think it's more of a dynamic workflow in that sense. So that's the main difference in terms of how we work and how we build, how we evaluate the products, right? The second difference is, I think, it's the goal that we're focusing on, or like the area that we're focusing on. So let's say if instead of focusing on all the products that we work on, we're actually focusing on the end goal that I mentioned. So let's say if one particular product allows us to achieve that goal better, then then that means that we have to focus on that product more, right? So I think that whole thing comes back to the fact that we are building an ecosystem since day one.
So with that under as like the kind of the social contract of alpha, an ecosystem from day one, that means that you need a team that can manage an ecosystem, right? That's more specific skill sets and straight up more of a larger team. So how did the alpha team assemble? Where did all of these people come from, and who are they?
Yeah, that's a question that, I got asked a lot, because, it's been quite a journey for us from, end of last year to today, right? So right now the team mostly is based in Thailand. The talent is pretty top notch in my opinion. I mean, others can think differently, right? And pretty much the way that we recruit are recruiting from Olympics, candidates. And these are a lot of these are already in Thailand. So Thai people are actually pretty strong in computer science and quant to begin with. And then, now that we have a core strong team, we're going to decentralize the whole team and expand the whole team going forward. So now we're actually recruiting globally for various roles for tech, for business development, for marketing. So expanding, not just limiting to Thailand.
So when you were assembling this team of diverse set of skills, you had this product in mind. And so what are the core competencies of the team? Like if the team was really good at something, and then how does that relate to that? What is that thing, and how does that thing relate to the product that you guys are trying to build out at Alpha?
Mm-hmm. I think there are three main things. One thing is that the team has to be really strong in math and coding. I mean, coding is a given, right? Like smart contract solidity and everything. But math is something that we really put emphasis on, because in order for us to build a cutting edge and innovative products and still be a safe protocol for people to use, math is going to be a really core component. Let's say if you go on Alpha Homora V1 or V2 now, each of the leverage level is, thought through. Nipun, who's the co-founder and CTO, is actually ranked the third in the global mathematics Olympiad. So he pretty much has done a number of research on what parameter you should go for surf pool, for ETH sushi pool. So it's not a random number that we are putting out to users to use. I think that's the number one core skill that we look for.
It is crazy to me. I just want to make a comment. It's crazy to me that DeFi is starting to attract this caliber of talent now. This certainly was not true in the 2017, cycle, but now it seems like it is true. We're getting top talent into DeFi working on these projects. It's super exciting.
Yeah, I think it's shown a lot of valuable reasons why people will want to come in, right? The fact that you are creating a new financial system, the fact that you're it's in the beginning of the whole new era. You're not late to the game. You're actually creating the whole future. So I think that's how people get very excited and able to attract these talents in, which is helpful for the whole DeFi ecosystem, I believe, not just for Alpha.
So I want to ask about what does math unlock? So you guys said that coding is a given, right? So all of these teams can code, right? And so all the coding isn't really the competitive advantage. It sounds like what you're saying is math is the competitive advantage that the Alpha team has. What does that enable? What kind of products does that enable you guys to access because you guys are good at math?
So to speak on Alpha Homora first, right? The way that it can offer high leverage and pretty much still be on a safe side is that everything is processed and all the loans and all the funds are held on the smart contract. The way that we do it and the way that we make sure that the parameters are still safe, allowing for buffer, even at liquidation, there's still another buffer to allow for more price swing. What's that buffer is going to be like? How are we going to be comfortable building a leveraged yield farming product while still having a comfort to ourselves, right? So I think that's for Alpha Homora. For Alpha X, it's the fact that we are capable of baking in the funding rate payments into the quoted price. So when building Alpha X, which is a decentralized non-order book perpetual swap trading product, we have in mind since day one that we are targeting anyone in DeFi who wants to trade perpetual swap without having to know that they're trading perpetual swap. Let's say that you want 10x returns if ETH price goes up, and ETH price goes up by $100, and now you're getting 1,000, right? So that's the end goal that you're getting. You don't have to understand anything in between. You don't have to understand funding rate or rebalancing or anything that is complicated, in perpetual swap trading, right? So that's the end goal. Now it determines on how do we get there? So math is going to be really important. How do we figure out a funding rate mechanism that just simplifies everything and makes it just into the quoted price? So when people trade on AAVE, for instance, it will be similar to a trading on spot market, in which the only prices that matter are the entry price and the exit price. So you can just take the two prices and calculate your net gains and losses without having to taking into the account of funding payments in between as well. So that's an example of math in AAVE.
So Tascha, let's maybe zoom out for a minute and talk high level about these products, right? So you mentioned two. You mentioned Alpha Homora and Alpha X. And I'm not sure if Alpha X is out yet, but maybe we'll get into that. I know Alpha Homora a bit better. And so that is basically a way to get like some sort of leverage yield farming sort of opportunities. Could you maybe describe that? And before you do, I'm going to ask a non-mathy question. So Alpha Homora, what's with the Harry Potter stuff? Are you guys big Harry Potter fans?
Yeah, Nipun is a really big Harry Potter fan. And with V2, we're generalizing the theme a lot more. So if you go to Alpha Homora V2 site, you can see that the only Harry Potter reference is the O with the lightning.
Okay. Okay. So it's like
the whole theme is more generalized.
Very cool. All right, cool. So tell us about the product then. What does it do?
Yeah. So as a user, you can use as a two-way for to maximize your yields on Alpha Homora. If you are a lender, then you can lend your assets and get high yields. On Alpha Homora V1, the lending assets is limited to just ETH. And that's because all the loans that leveraged yield farmers are taking are based on ETH. So that's why, the lending asset is limited to just ETH, and that's why it can generate really high lending APY for ETH holders, because once you lend these ETH, it's the leveraged yield farmers who are borrowing these ETH to yield farm and get the high APY. And hence they're willing to pay the borrowing interest rate because they're getting a lot higher APY on leveraged yield farming. On V2, the difference is that with the lenders, you're not limited to just ETH. We're expanding, the list of assets in lending pool to be a lot larger. So right now, if you go on V2, you can see that ETH, USDT, USDC, and DAI are assets that you can lend. And then going forward, there will be more assets that you can lend as well, like YFI, SNX, DPI, and the list goes on, right? So Alpha Homora V2 will continue to grow from the lending aspects and also continue to grow from the leveraged yield farming pools as we continue to add more pools aspects too. So that's from the lender's side, and a bit more detail on the leveraged yield farmers side. So once you come in, there are pretty much three main things that Alpha Homora simplifies for the leveraged yield farmers. Number one is, of course, you get to unlock that leverage. So that means that you don't have to manually borrow loans from one place, and then which is also over collateralized loans, and then compile that loans with your liquidity to begin with, and then you farm, right? So we simplify that by having you to take on leverage that is under collateralized loans as well. So let's say if you take 1 ETH to supply, you can borrow like 1.5 ETH. So it's even more than what you supply. So that's the one thing that a farmer does for leveraging farmers. The second thing is that when you take your liquidity to supply in the first step, you don't have to have equal value of both. So let's say you want to provide liquidity, or you farm on ETH sushi. You don't need to have ETH and sushi. You have any proportion. We're gonna take care of that for you, either through swapping optimally or other ways, right? And then third thing is that we complete the whole yield farming process for you. So once you supply liquidity, once you determine what assets you want to borrow in what proportion, once you determine the leverage level, everything is all taken care of for you, which means that, taking the LP token to stake, collecting the farm token, all of those things are pretty much all done by Alpha Homora.
So I would like to know where the yield actually comes from. And so in my mind, I'm getting an image of like the urine vaults, right? Where there are different strategies that return different amounts of yield based on what those strategies are. And if you want to go peek under the hood, you can go find out what those strategies are. Where does the yield actually come from with alpha? Like, where is that? Are there vaults? Are there strategies? Like, what is the yield generation mechanism?
Mm-hmm. So there is one main strategy, which is that it's taking the liquidity you supply and the borrowed funds that you determine to enter at. So let's say 2x leverage, then it's half of your position is going to be the debt that you borrow. So take all of that and supply to the liquidity providing pool that you select. Let's say you select ETH sushi, for instance, then it will supply to ETH sushi on SushiSwap, and then it will take the LP token to stake in the liquidity mining pool for you to claim sushi. So that's the main strategy for all the pools on Alpha Homora. The difference would be which pool you want to provide liquidity or you farm. So let's say the APY on ETH sushi will be different from the APY from Curve 3 pool, which is providing USDT, DAI, USDC on Curve farming CRV token. So that's the high level, and then the APY for each of these pool will pretty much be coming from 3 parts, with also minus the borrow APY, so 3 minus 1, right? So the first part is the yield farming APY, which is on leverage. So let's say if you were to provide liquidity or you farm on ETH sushi, let's say you would get 15%. And if you take 2x position on Alpha Homora, then that means that you're getting 30%. Because you're providing 2x more liquidity, hence you can farm with 2x more of the liquidity and get more sushi, right? The second thing is trading fees APY, which is also on leverage. So let's say if you were to get 10% trading fees APY on a pool and you do 2x, then it would be 20%. The third thing is Alpha APY, which is the current liquidity mining program that we're running, making sure that we help migrate V1 to V2 smoothly. And then, those are all the positive APY. The negative APY is the borrowing interest rates that you have to pay based on what assets you borrow and how much you borrow.
So the yield comes from other protocols issuance of their like equity token, right? So then the sushi ETH pair that comes from sushi being distributed from the sushi protocol, and then when you talk about Curve, you're talking about yield farming the CRV token. So my mental model has now gone from just Yearn and vaults, but Yearn and vaults plus DYDX, which has margin and leverage, right? So if you slap these things together, are we generally pretty close to what alpha is?
Yeah,
cool.
For what Homora is, yeah.
Cool.
And then what are the risks? So can we talk about a risk
and who's taking
the risks? Them? Yeah, yeah, the risk for someone who's doing this kind of leverage yield farming.
Mm-hmm. So smart contract risk is always going to be there. We try to mitigate as much as possible, doing various audits, having other builders in the space, reading through the codes. So that's by everyone who's using the product bearing that risk, right? For the leverage yield farmers, your risk are on pretty much making sure that your position will not get liquidated. Because if your debt is too high comparing to the collateral that you put in, then you will reach a liquidation point. So you can monitor with your debt ratio number. So if your debt ratio is at 100%, then that is the liquidation risk that you're in, which means that other liquidators can come in and liquidate your position. What that means is that liquidators will get 5% of your position value, and then 95%, depending on how much debt you have, right, will be used to pay back the debt that you owe, and then whatever is left is sent back to you as a user. So that's the risk that users have to be aware, especially when prices swing and can make the position be closer to liquidation risk. One thing to note is that for the Curve 3 pool, because all the components are stable coins. So if you supply stablecoin and you're also borrowing stablecoins, then the risk is actually lower than the other pools. Let's say ETH sushi, that you are providing ETH or sushi and borrowing ETH. So you can see here that the stablecoin pools, assuming that the stable coins are, to their peg, then the position is less likely going to be moved towards liquidation because the debt portion doesn't really move that much, because of the peg system of the stable coin. So that's on the yield farmers, right? On the lenders, the risk is that, if the positions or leverage positions become underwater, then partially the funds in the lending pool may be used to cover that loss, right? But nothing to be too worried. We actually have several mechanisms to prevent that. The first mechanism is that even when it's at 100% liquidation, but even when it's at 100% debt ratio, which is the liquidation risk, we offer another buffer scenario, which means that at liquidation risk, the positions are actually not underwater yet. So that's the one thing that we do. The second thing that we do is that Alpha Homora B2 also takes 20% of the borrower's interest rate to set aside as the insurance funds. So, if we have to cover the losses on the underwater positions to cover the debt, right? Then this insurance funds will be tapped first, before tapping into the funds in the lending pool.
A pile of insurance funds sounds like a fascinating topic that I think there's probably a rabbit hole there. But first, before we go there, I want to ask about the collateralization ratio. Did you just imply that you could actually have an even amount of debt to collateral in the alpha system?
Yes. So the way that Alpha Homora works, it's not similar to the other, let's say, lending protocol. And the key difference is that each asset actually has a collateral credit and a borrowing credit. So this is different for the other lending protocol, or like the mechanism that has been used widely in lending protocol, because typically there's no borrowing credit, there's only collateral credit, or the collateral loan to value, right? Let's say if you take 1 ETH, you can borrow approximately 70% value of that 1 ETH. And then you can borrow anything within that 70% value of that ETH, right? What's different with Alpha Homora V2, and hence it's kind of harder to calculate what's the exact collateral ratio on top of anyone's head. You need like the Excel to do it, because that when you supply, let's say, ETH, you would get a collateral credit value. Let's say you get, for instance, 1 collateral credit value, right? And then if you're going to borrow DAI will consume, for instance, 0.5 collateral credit. So which means that you can actually borrow 2 DAI in this case. So assuming that the price is 1-to-1 for simplicity, right? But if you collateral with 1 ETH and you get 1 collateral credit, and if you're actually going to borrow Sushi, for instance, Sushi would actually claim and pretty much require 1.5 credit to borrow, which means that if you supply 1 ETH and you have 1 credit, you actually cannot borrow Sushi because it requires 1.5. So that's the mechanism that we do, which means that the collateral ratio depends, and pretty much also the leverage ratios depend on 2 things: what assets you bring in as collateral and which assets you're borrowing. And not just which asset you're bringing as collateral.
And how are these parameters determined?
Well, Nippon. So Nippon is, pretty much owning the main mechanism of, what parameters we offer, to ensure that it's safe and also still able to offer leverage. And we have this huge Excel that we also do to make sure that we update, every week, depending on the price. And making sure that the parameters that we set is still within the range that we are okay with.
Okay, would you characterize that as a hands-on endeavor? Is that something that is updated frequently, or like what is the long-term plan for maintaining this balance? It seems like a delicate balance that if someone isn't having like their eyeballs on it all the time, could get out of hand.
So technically, you don't have to look at every week. We just do so now because we just launched V2, so we want to make sure that everything is fine. As the migration process has been going, right? And all the parameters on Alpha Homora V1 and V2 actually have taken into account the worst case scenario. So let's say if there's a really huge price swing, or anything in the past that, cannot lead to a good event. That is something that we also have taken into account. And the leverage that we offer pretty much ensure that, if that scenario were to happen again, it would be mitigated. Although we cannot say that it would not happen because we don't know, what else is going to happen in DeFi, right?
So can we talk a little bit about lending on Alpha Homora? So you could lend your ETH, at least in version 1. Now in version 2, you can lend all sorts of other assets. What are the typical interest rates? Because it was fairly attractive in Alpha V1 for ETH. It was something like I don't know, 4 to 8%, somewhere in that range. Is that about right?
So typically it stays around 8% in V1 and then goes up to like in the 10s, in the 20s sometimes,
Wow.
when the utilization rate goes really high. And I think the key thing with that is the interest rate model that we use is a 3-slope curve, and I think that works really, really well for high utilization assets. So
Can we
let's
define
say,
that? Can we define what that is?
yeah, so typically there is only one kink, right? Let's say like it's here and then it's here. Given whatever utilization rate you want to set the interest rate to be higher, what we do differently in V1 and also going to adjust in V2 as well. Right now, the V2 is not 3-slope curve yet. So in V1 is that it's going to be like this. It's going to stable at around 80 to 90% utilization rate. So which means that at 80 to 90% utilization rate, the borrowers are paying fixed fee. Fixed borrowing APY. And it was flat at 10% APY, 10% borrowing APY, which correlates to about 8% lending interest rates. And the fact that I tell you that, typically it stays around at 8% is because we want the borrowers to be at around 80 to 90%, because we think this is the optimal for both borrowers and lenders. Lenders get high APY without risking the funds locking, without being able to withdraw. And then the borrowers get, a fixed APY within this range, right? And then after 90%, then it would go up really steeply. So this gap is only 10% from 90 to 200%. So that's why when the utilization rate goes beyond 90%, borrowers typically just close their position because the APY to borrow the funds are too high now. So yeah, with this 3-slope curve, it allows us to generate pretty high APY.
Okay, so the 3 slopes are there a first long slow slope where the interest increases a little bit, but not that much, from 0 to 80%, and then from
Correct.
80 to 90% it stays flat at a relatively low, but still, well, not too low, I guess, but it stays flat from 80 to 90% utilization of the ether deposited. And then once you hit that 90%, it goes up really, really fast because you can't get to 100% because that's bad. And so that plateau that you create offers stability in yield for the suppliers and the borrowers, and that just makes things more stable, which that's pretty clever. And so you're both incentivizing. You're incentivizing just capital efficiency. I think that's pretty elegant.
Yeah, so that's the math behind the high APY on lenders as well. And your second question, Ryan, you were asking, what's the APY on V2, right? There are many assets. So right now we're migrating more of ETH and the pools and also the lenders from V1 to V2. So the APY on ETH on V2 right now is about 5 to 6%. And then on stable coins, it's about 30%, including the alpha APY too. Yeah.
Wow. Okay. All right. So David, he's a bit of a DeFi degen, not like me. So I know he's gonna use the borrowing side of Alpha Homora a whole bunch. But I'm a simple holder and I like yield. On my stable coins, I like yield on my ETH. So I might be more interested in lending. But what I want to understand if I'm to lend to something like Alpha Homora, let's say I put my ETH in Alpha Homora, is kind of the risk level, right? And so something like ETH V2 right now in staking I can earn about 10%, maybe 11% smart amount. Of course, my ETH is locked up, but it's a different story. But at least the risk I have there is kind of hypothetically should be protocol type risk, right? Or risk that ETH2 never ships. What sort of risk am I subjected to when I deposit into Alpha Homora as a lender? And I know you mentioned some of this. I just want to wrap my head around it because I know there's smart contract risk. People are familiar with that with all DeFi protocols. What other risks? You also mentioned some basically some risk on the kind of the borrower side if they go underwater somehow. But can you walk me through that one more time to make sure I understand what kind of risk there might be?
Sure. So when positions are underwater, which means that debt is more than collateral that they inputted, then when that case happens, then the protocol will need to find the funds from somewhere to cover that debt, right? The first place that the protocol would find that fund is the insurance pool that we have, which is coming from the 20% of the borrowing interest rates that the borrowers are paying. And then once the protocol taps into that pool, and if there is the need to find more funds, then it would tap into the pool of the lending assets that will cover the funds. So I think it's more of, you can treat it as the secondary place that the protocol will look at, and only at the event in which liquidation, in which the positions are underwater. So in order to have a position to be underwater, that means debt ratio would have to reach 100%. And then when it hits 100%, no one is liquidating that position yet for a long time, because we give quite a huge buffer even at liquidation, which means that when positions are at liquidation, the positions are not underwater yet. It has some room to allow price to swing. Within that room, depending on how fast price swing, but within that room, liquidators should already come to liquidate given the incentives that they get, right? But somehow, if they don't come in and price keeps swinging, and position becomes underwater, because debt keeps rising and collateral remains the same, then the mechanism would be to tap into the insurance pool and then later on the lending pool.
Got it. Okay, so there's some backstops there, and I'm wondering, like, what would happen in the case of something like a Black Thursday that we saw? Man, it seems like a very distant memory, but it was less than a year ago when we had sort of a major, almost a black swan event of a pretty large ETH drop in one day, and maker, keeper bots, liquidator bots had trouble keeping up. And liquidating sort of the collateral positions. Could Alpha be subjected to something like that? So that too as a risk. And then also, are there Oracle risks involved here too?
Yeah, actually, before I jump into that, one thing that I forgot to mention is that on the lending side, this is actually similar to the other lending protocols as well, in which that your funds are pretty much going to be subjected to, the risk will be if the borrowers don't pay the debt, right? Because technically your funds are with the borrowers, and if the borrowers don't pay, then that's a part of the funds. So that's similar to the other lending protocols. The difference is that utilization, well, not utilization, but yeah, the difference is that utilization on Alpha Homora is usually higher than other lending protocol, just on the basis of leverage yield farming product itself, right? So yeah, so that's one thing to know, that it's similar lending risk as you were to lend in the other protocols too. So now back to your question with Black Thursday, right? Yeah, so there are several scenarios that we try to make sure that the parameters take into account, including Black Thursday. However, we have not simulated that scenario because we cannot simulate that scenario, right? So we try to mitigate as much as possible, given the parameters, especially which means that when it's at liquidation point, we set a huge buffer still. So that's one way to mitigate that. And another thing that is coming as well is that we are working with a number of liquidation protocols to make sure that we not just limit to the bots or other liquidator data in the space, but actually working with liquidation protocols to make sure that we have a strong backstop system. So one of the protocols we're talking to is B protocol. So we're trying to see how we can leverage their technology that they have come up with as a backstop for DeFi protocols and see how we can fit with the whole puzzle here.
That's crazy. B protocol. So I've not even explored kind of liquidator protocols. There are entire protocols that are just made to liquidate. Is that right?
Yeah, correct. So that's what they do. I just talked to them last week. So yeah, they're pretty new. So it's worth exploring, but we're also exploring on the tech side as well to see if it would be easy and good to integrate.
David, the money robots are getting smarter. It seems like. I've got one question for you, then we're going to pause for breaks, and then we are going to get to all of the community questions that are coming in. And that is like, it seems to me, Tascha, that you guys have taken an approach almost like Andre from Wire and from Wi-Fi. He came on, which is like, I'm just going to build the thing that I think the community needs right now, right? So it seems like you have, I'm not sure how your team did this, but you've figured something out in DeFi that has very strong product market fit. And the reason I know this is because Alpha Homora is a relatively new protocol. Is like, how many months has it been live at this point?
In 4 months.
4 months. Okay, 4 months. And you're already locking, I looked sometime today, close to 700,000 ETH, right? That's like 1.2 billion ETH. Like it's an ETH eater. It's an ETH monster that you've created. And that to me screams of product market fit. I'm just curious. So how did you do it? How did you, was it just like kind of a guess that, hey, this is something that we think DeFi needs, and then you just, built toward that? Or are you DeFi users and you just like felt this case yourself? Or like, how did you find this product market fit so quickly?
Mm-hmm. Yeah, so I think that's the key with finding and recruiting our team. We are, our team are pretty much active DeFi users in the space, and also passionate in the space. So they don't just work and code, and pretty much they are active users and reading Twitter, pretty much very into the whole ecosystem, right? So that means that all the ideas are actually coming from everyone, not just me or Nipun. And we usually get various ideas from all the engineers all the time. And pretty much once we saw and once we realized that there's a huge, gap in the ETH side, which means that there are so many ETH holders in the space. And if you go on any of the place that you can lend and earn the yields are really, really low. And I'm sure if you ask anyone who's holding ETH, if you want high lending interest rate, I'm sure they would say yes. So then that gives a light bulb moment in which that we just need to find a way to innovate on the borrowing side and create an organic high lending APY on ETH, and that will give a strong competitive edge and a good product market fit to begin with, and then we grow from there. We did not expect that there would be V2 so quickly as well. So I think everything is more on adjusting to what the market needs, like you mentioned.
Yeah, super smart, because as an ETH holder, I know, and there are many of us, like we're strong holders. We've been through a bear market, right? And there's really not much you can do to generate interest on your ETH in DeFi. I mean, the best you could do is maybe put it in a crypto bank like a Celsius or a BlockFi or something like that. But in DeFi, aside from just staking it in ETH2, there's really not many places to put it to earn some interest. And you guys have created that. I think that is a huge part of your success. So, hats off. But like, were you surprised by the volume of assets under management that you accrued in 4 months period of time? Did that even surprise you?
Yeah, that surprises me too. And I think it's great to not ignore that light bulb moment. And I think this gives more clarity that light bulb moments are really, really important. It may not be that idea that you think at that moment, but then if you just stick to it and find an angle that plays with that idea, then that should work. Especially if you've been in the space for quite some time, I think the value of Lightbulb Moment will become more and more valuable.
Yeah, just to put it into perspective for listeners, Alpha Homora is locking up, or Alpha at large, Alpha Homora is locking up 75,000 Ether, where AAVE is only locking up 420,000 Ether, which is just crazy. You almost have them doubled, which is pretty cool. There are so many more things about Alpha that I want to get into, including Alpha X and this pool of funds that is backstopping Alpha Homora. And so we're going to get into all of those details right after we get back from a break to talk about some of these fantastic sponsors that make the show possible. Synthetics is Ethereum's decentralized derivatives liquidity protocol. What does that mean? Synthetics is a platform for creating and trading synthetic assets, which are assets that are priced via an oracle rather than bids or asks. Traders can use the KWENTA exchange, which hosts and trades all of the synthetic assets created by Synthetics. Traders on KWENTA can trade synthetic tokens like SBTC, SOIL, or SDeFi. Because KWENTA is powered by Synthetics, traders experience zero slippage on their trades. No, I didn't mean low slippage. I meant no slippage, because that is the power of the Synthetics platform. No slippage on your trades. You can also easily short assets with iSynths, which are synthetic assets that move inversely to their target asset. Synthetics isn't just for traders. Developers can build on Synthetics to access the infinite liquidity offered by synthetic assets, or investors can stake collateral to the protocol and earn fees that the protocol collects. If you're a trader and you're looking for a trading platform not found in the legacy world, check out KWENTA.io. If you're a developer or you just want to earn yield on your collateral, go to www.synthetics.io, where you can stake your SNX or ETH and earn fees from Synthetics. If you want to live a bankless life, you need to get a Monolith DeFi Visa card. Monolith is both a 1-2 punch of an Ethereum smart contract wallet, as well as an accompanying Visa card that lets you spend the money that you have in your Ethereum wallet wherever Visa is accepted. It's really a fantastic tool that lets you use Ethereum for what it does best, which is holding and managing your financial assets, but also keeps you connected to the rest of the world's payment rails. Monolith also offers ONRAMP services for getting your fiat money into the world of DeFi. So it's trivial to top up your Monolith card if ever you need to, and your deposited money goes straight into your non-custodial wallet. So your money is never held by a centralized intermediary because your Monolith wallet is native to Ethereum. Monolith helps you transcend both the legacy and the crypto worlds because the money that you hold in your Monolith wallet has the power of DeFi behind it. Swapping assets on Uniswap or earning yield in DeFi is at your fingertips. But with Monolith, so are the groceries at your grocery store or the coffee at your coffee shop. Go to monolith.xyz to sign up and get your Monolith Visa card today. All right, guys, we are back with Tascha from Alpha, and we have talked all about Alpha Homora, and there are a few more things we want to talk about, and then we're going to get into some listener questions. So if you are watching on the YouTube, first off, thanks for being there, and now is the time to get your questions in. While you are doing that, don't forget to hit that like button, and we'll get to those questions in a little bit. But I want to ask about Alpha X, because Alpha X is a different product than Alpha Homora. So Tascha, can you tell us about Alpha X?
Yeah, so it actually came from the market demand again that we saw once we launched Alpha Homora, right? That demand is that they want to use leverage farming product, they want to use Alpha Homora, but they don't want to be in a position in which they're shorting ETH. To give more details on Alpha Homora V1, in which all the leverage is based on ETH. If you supply not in equal amount, and let's say you're supplying 1 ETH and you're borrowing 1 more ETH to you farm on ETH sushi, right? Then that means that 1 ETH has to be converted to sushi because you still need both to provide liquidity and you farm. So that means that you're in a position of shorting 1 ETH because you're technically selling the ETH now. If the ETH price goes up, then that means you have to buy at a high price back to pay the loans, right? So when that's the case, then a lot of community members, a lot of users reached out to us saying that, is there a way to hedge their positions? They don't want to short the ETH. So that gives another light bulb idea that, hey, we should actually just create another product that will grow in its own area, but still provide this ability to hedge and provide synergy to Alpha Homora. So, that's how we came across the idea of Alpha X, which is a non-order book, decentralized perpetual swap trading product that will grow in this area and still provide Alpha Homora V2 users to be able to hedge their positions. So when we launch Alpha X, there will be a simple UI for users to just click hedge and then, take him through the whole process and open another long position on Alpha X to make sure that they're both in a market neutral leveraged position. So that's, on the high level. I can talk more about, how Alpha X is unique from the other, protocols in this space and what do we look to grow Alpha X into.
Yeah, do that. And is it out yet, or is it when is it coming?
It's in private testnet right now. So we're working on adjusting the parameters based on the data that we have got from the private testnets. And then, depending on how much we have to adjust on the parameters or on the smart contract, usually not on the smart contract level, but more on the parameters to ensure that it scales and also safe to use. And then the next step would be to launch public testnet. So yeah, a bit more about Alpha X is that, the fact that it's non-order book is already a good thing, which means that you don't have to bootstrap liquidity to be able to trade on Alpha X, right? Another thing that is, really unique about Alpha X is that, which is what I mentioned earlier, is we baked in the funding payments or funding rate payments into the price. So which means that on Alpha X, there is only one price. Whether you open a position, whether you close a position, that's the price you're doing it against, right? And in order for us to simplify the funding rate payments, we bake that concept into this price. So which means, for instance, if the long were to have to pay the short, then we would shift this price down automatically. So the long would not have to pay the short, but if the long were to close a position, they would close at a lower price than if they were to close before the adjustment. So hence they are paying the short indirectly by default. So that's the one main thing that's unique about Alpha X. The second thing that I really like is that the positions, the leverage positions on Alpha X are tokenized. It's going to be wrapped into ERC20. So which means that, wherever Alpha X is, be it on Ethereum, be it on L2, which we are exploring as well, users can still unlock that interoperability because once you port that ERC20 out from L2 to the other protocols in L1, then you will be able to use more benefits and do more things with this tokenized positions.
Very cool. All right. Well, Tascha, you've teed us up for our first reader question here. So this is from someone in the Bankless Discord asking about your layer 2 strategy. So you just mentioned that Alpha is exploring it. What are you exploring? What looks good in layer 2 and what are you planning to implement?
Yeah, so we're actively talking to various layer 2 protocols, looking to deploy, Alpha X on layer 2. So this is the next step for Alpha X. We're actively evaluating various layer 2. The fact that the positions are tokenized makes it still possible to interoperate with the other protocols. So that's why we decided to start first with Alpha X, be on L2. Typically when we build the products on Alpha Finance Lab, right? We don't like to have the product operate as a standalone product. We like to have it as an ecosystem. Even with Alpha Homora, there's a huge partners and ecosystem that it, partners with. With Alpha X, we're using the tokenized positions as the way to create an ecosystem for Alpha X. So yeah, depending on which L2 we're going to choose, the public testnet should also be on that L2 as well. So that would be upcoming in the near term future.
And Tascha, do you have any general directions as far as L2? Are you thinking more like optimistic rollups or ZK rollups or something else entirely?
Yeah, we're thinking more on the optimistic rollup. So we're actively talking to various protocols in that area.
Very cool. Thank you.
So we have a question from Carl in the Bankless YouTube about the Alpha token. And this is a question that I have as well. What role does the Alpha token play in the Alpha finance ecosystem?
So we actually have finalized the Alpha tokenomics. And we actually have started, working on the technical details, writing the smart contract, adjusting Alpha Homora V2 to bake in that alpha tokenomics. So I think that's the high level that I wanted to share. I think another thing that is good to know now is that there are multiple factors in the alpha tokenomics. So when we create something, we don't just create from a one layer or one perspective. We try to always be more creative and innovate something that we do, right? So that's the same for alpha tokenomics. So there's one component that is similar to other protocols, and then there's another component that is also something new and creative. And we're really excited on launching a combination of both. So yeah, more details to be shared. I'll make sure to share as fast as possible when we can, and making sure that we explain very thoroughly on the new idea that we have come up with.
Are you viewing your token as kind of part of an ecosystem as well? So one token across all of the alpha products, is that right?
Correct. Yes.
Okay.
And then another question that I've been seeing a lot in the Bankless YouTube comments is about that insurance fund, which I promised to come back to towards the end of this podcast. So here we are. There's an insurance fund that you guys have that is backstopping some of the activity going on in Alpha Homora. But Alpha seems to be having there seems to be a social contract of capital efficiency. So what else is this insurance fund going to be used for? Is this going to be tapped into in any other sorts of ways in the future?
Yeah, actually, it's gonna be related to the alpha tokenomics. So that should be
Spoiler, spoiler alert.
Yeah, we got it.
Nice, David. Well done. Very good. Another question came in on Twitter, and this was, I think, from a developer. So would love to understand Alpha's plans to allow developers to build on Alpha. You've mentioned in the past, Tascha, that there was this possibility. So any thoughts on timing, what you'd like people to build? And the person is asking because he is one of the people who actually wants to build on Alpha. So what can you tell developers about building on Alpha at this point?
Yeah, so I think at this point, myself and the team, we have to grow the community initiatives a lot more, including, more grants, more growing the developer mind share for the whole ecosystem. So that's in progress. And pretty much, in the meantime, as that's being grown out, if you have any particular idea you want to build on top of Alpha Homora, on top of Alpha X, or any other upcoming Alpha products, just feel free to reach out directly to me on Discord. Although I reply a little bit slow, but I reply. So just DM me and with ideas or anything like that. For the long-term solution, we're going to build out more of a decentralized grants, and pretty much allowing developers in the space to be able to contribute and be able to have a say on what should be built on alpha products.
You guys did get praise so far in these YouTube comments from someone. I remember reading a comment about how attentive and patient some of the explanations out of your guys' Discord was. So the Discord is the community gathering place for so many of these protocols. So having a good one is really important. So nice job there. Another question that we have out of the YouTube is, are there any teasers on what pools they are looking to add to the 4 that they currently have available in V2 already?
Yeah, so more pools are upcoming. A bit teaser just for Bankless listeners and audience are, ETH YFI is coming. You would also be able to take a leverage on YFI. So that also means that users can lend YFI as well. So there will be an IB YFI token generating high yields on YFI. And then the same mindset will grow to, other assets like DPI, SNX, and so on and so forth.
IBYFI. Wow, that sounds crazy.
There you go, Bankless. There's some alpha leaks on our alpha conversation. Yeah, had to fit that one in, David. You know I was going there. Another question coming in from Bankless Discord this time is actually about your partnership with Yiron. So what has Alpha gained from partnering with Yiron up to this point?
Mm-hmm. So I think a lot of times, the gains are more long-term and relationship building. And I think we're here for the long-term perspective, right? So sometimes the gains are not quantified to, oh, we get X amount of loans or X amount of, lending assets on the product. But I think it's the relationship that we have built, in a sense that whatever we do, we will try to benefit the partners, and same for the partners. Whatever they do, they would try to be wary of us and make sure it's something beneficial to us. So that's on the long term, right? On the short term, Andre and Yearn itself actually have been lending through Alpha Homora V2 as well. So to give more color on that, the Yearn V2 DAI and USDC vaults, these are lending on Alpha Homora right now, to pretty much grow the liquidity pool of lending assets for the leveraged farmers to take the leverage on. So that's on the short term, and once we find more angles that we can work together, then it will grow from there. And we're using Cream as the liquidity place that we take the liquidity from to allow leverage users to take leverage, right? So Cream is also a part of your ecosystem, and integrating with Cream also helps grow the Yearn ecosystem too.
Oh, curious. So why Cream?
Mm-hmm. I think because of several things. I think when we were building Alpha Homora V2, Cream was at the injection point in which Yearn just acquired, or acquired Cream. So they were up for a new change, right? And I think in order for a lending protocol to allow Alpha Homora and pretty much whitelist Alpha Homora contract, they themselves have to adjust their contract too. So Cream would have to, adjust on their code, saying that they would whitelist Alpha Homora V2 and allow Alpha Homora V2 to borrow in an under collateralized way. And Cream was up for that because it's at an injection point, and we are also close to Andre to begin with. So it's kind of like pretty easy to talk to, and I think he has a lot of good ideas to pretty much find a way to grow Alpha and Yearn ecosystem as a whole.
Okay, a Bankless member is asking about the harvest function on V2 and said that the cost is $500 in gas at 100 GWE. Why is it not optimized better? Do you guys have any plans to continue to optimize gas costs in Alpha Homora V2?
Yeah, I think several points to that, right? First point is that Alpha Homora does a number of operations for the users. The more complex your strategy is, the more gas cost is going to cost. So what determines complex strategy, right? So let's say if you are supplying only DAI to the Curve 3 pool and you are borrowing, 75% USDT, 10% DAI, 10% USDC. So it's pretty complex. Then that means that all of these have to be gone through a number of operations to make sure that you provide liquidity in same proportion on Curve, which already has pretty high gas to begin with, comparing to other AMM protocols, to get the CRV token. So to prevent high gas costs, one way to do it is to simplify the operations on the user's end. On our end, though, there are several things that we're looking to do as well. One thing is, we understand that claiming the farm token can cost a lot, especially now when the gas cost is really, really high. And there have been a lot of community members wanting to put up a proposal to create another option to reinvest. So that is something that we're looking into as well for users who don't want to pay high gas fees and still want to claim the rewards. They could be able to choose the reinvest button. It's still to be determined. The community members would still have to put up the proposal and evaluating through the risk parameters as well.
Another question that came in was about, so Synthetics recently launched synthetic stocks, starting with Tesla, so S Tesla, everyone's favorite in crypto these days. Does Alpha plan to incorporate any of these assets? The idea of a trustless, decentralized kind of synthetic stock is pretty appealing, especially in the US, when exchanges like Robinhood are shutting down our GameStop stocks. Any plans around this?
Wow, you're actually leading me into more alpha leagues.
Oh, okay.
Yes, this is what our jobs are for.
Yeah, found one.
Yeah, so that's something in our radar, and we're working towards it. So would not say it's not going to happen, but also don't want to commit on any timeline.
Would that be like a separate product in your ecosystem, do you think? Or would that be kind of something that could be incorporated into the two existing products?
More on the incorporating into the existing.
Very cool.
Very
Very
interesting.
cool. So a lot of what we're talking about is, especially with Alpha Homora, Alpha X, partnership with Andre and Yearn and all that stuff. That's all on-chain stuff. And so I have a question on the Bankless YouTube about what are you doing to drive usage on the social side of things, the human side of things? Like, is there a marketing department? Is there a business development? What's that side of things like?
Good question. I think that's very important. And typically, we just focus, a lot on the product, understanding the product and everything. Yeah, we have a marketing and business development department, and pretty much the way that we work with our partners is even if there's nothing that we can do together yet, we still would like to get in touch early in case there's anything that we can do for other alpha products, right? Because we're always going to be thinking of new products, new solutions to the space. So the more we know, the better. So we can see, oh, this product would actually benefit this partner, and we can work together on, this new product. So that's been, pretty ongoing and actively driven by the BD and marketing team.
Tascha, this has been a fantastic conversation. I learned so much. This has been an AMA that, I personally probably learned the most out of any AMAs that we've done previously. So thank you for that. You guys have built a phenomenal product with some great product market fit, and you're doing a great job. So well done, and thanks for joining us on Bankless.
Thank you so much, David, Ryan, and everyone in the Bankless community.
And Tascha, if anyone listening, any of the listeners on the YouTube or listeners on the podcast want to go learn more about Alpha, where should they go? How can they join your guys' community?
Yeah, so first place is you can go to the website. The website has everything, link to Discord, link to Twitter, Telegram, link to all the blog posts that we write, all the documents. So, everything is aggregated on the website. So it's alphafinance.io, and then you can go anywhere in our community from there.
Well, fantastic. Well, Bankless Nation, this has been another AMA. One thing we want to tell you before we let you go, there is a consensus conference that is coming May 24th. I will be there. David will be there. We just learned that Ray Dalio will be there. And if you sign up now, you can get $20 off that conference. Definitely check that out if that's something you're interested in. Way more fun to attend crypto conferences during the bull market. We are definitely in a bull market for the ages. So check that out. Tascha, thanks again for being with us. Of course, risks and disclaimers, everyone. ETH is risky. So is DeFi. So is Bitcoin. We didn't talk much about Bitcoin these days, but we did talk about how to put your ETH into Alpha Homora, and be careful. Of course, you could lose what you put in. None of this has been financial advice, but this is the frontier. It's not for everyone, but we're glad you're with us on Bankless today. Thanks a lot.
And if you are on the Bankless YouTube, make sure we get Tascha and Alpha to the front page by liking the video and also subscribing to the channel for future AMAs and all the future content that comes out of the Bankless YouTube. Thanks, guys.